Accounting Standards. Accounting Standards. The Institute of Chartered Accountants of India, ICAI, recognizing the need to ease the diverse accounting policies and practices, constituted an Accounting Standards Board ASB on 21st April 1977. Need of accounting standards. The SEBI, that is Stock Exchange Board of India, and Companies Act 2013 require auditors to qualify the audit reports that do not conform to mandatory accounting standards. Section 134(5) of the Companies Act 2013 also casts a responsibility on the Board of Directors to comply with mandatory accounting standards. Under the Section 129(5) of the Companies Act 2013, where the financial statements do not comply with the accounting standards, such companies shall disclose three things: the deviation from the accounting standards, the reasons for such a deviation, the financial effects of, if any, arising out of such a deviation. Accounting Standard 1. It is mandatory from 1st April 1991. It deals with disclosure of accounting policies. This standard is applicable in the areas of treatment of goodwill, valuation of inventories, valuation of investments, valuation of fixed assets, methods of depreciation, treatment of retirement benefits, treatment of contingent liabilities. Accounting Standard 2. It is mandatory from 1st April 1999. It deals with the determination of the values at which inventories are carried in the financial statements until the related revenues are recognized. It states that inventories are to be valued at a lower of cost or net realizable value. Accounting Standard 3. It is mandatory from 1st April 2001. It deals with the preparation of cash flow statement and its presentation along with the financial statements. Cash comprises of cash in hand and demand deposits with the bank. Cash equivalents are short-term high liquid investments that are readily convertible into a known amount of cash. For cash flow statement, current items of balance sheet are classified into three categories, that is, cash and cash equivalents, trade current items such as debtors, bills receivables, stock, prepaid expenses, accrued income, bills payable, creditors, outstanding expenses, income received in advance, etc. Non-trade current items or current investments cannot be classified as cash equivalents, such as short-term advances received, short-term advances made, and current liabilities for fixed assets. Accounting Standard 4. It is mandatory since 1st April 1995. It deals with the treatment in financial statement of contingencies and events occurring after the balance sheet date. Contingencies are events whose outcomes will be known only on their occurrence. For instance, case pending in any court, penalty proceedings under law are events whose outcome will be known only on their occurrence. Accounting treatment of contingent losses. If a contingency will result in a loss to the enterprise, then it is prudent to make a provision for that loss. If there is insufficient evidence, then disclosure is made of the existence and nature of the contingency. Accounting treatment of contingent gains. Contingent gains are not recognized. If realization of gain is certain, then accounting for it will be appropriate. Events occurring after the balance sheet date. Adjustments to the assets and liabilities are required for events occurring after the balance sheet date. Some events, such as proposed dividend that take place after the balance sheet date, are rectified in the financial statements due to statutory requirement. Events that may indicate that the enterprise ceases to be a going concern, such as the destruction of a production plant by any disaster. Accounting Standard 5. It is mandatory since 1st April 1996. This standard deals with the treatment in the financial statements of a prior period and extraordinary items and changes in accounting policies. Prior period items are debits or credits that arise in the accounts of current year because of a mistake or omission in the preparation of the financial statement of one or more earlier years. Circumstances which may give rise to a separate disclosure of items of income and expense are the writing of inventories to net realizable value and a restructuring of the activities of an enterprise, disposal of items of fixed asset, disposal of long-term investments, legislative changes having retrospective application, litigation settlements, other reversals of provisions. Changes in accounting estimates are uncertainties inherent in business activities. An estimate may have to be revised if changes occur regarding the circumstances. Change in an accounting policy should be made only if adoption of different accounting policy is required by statute for compliance with an accounting standard. Accounting Standard 6. It is mandatory since 1st April 2003. It deals with the accounting for depreciation and the disclosure requirements related. It states that the depreciation method should be selected carefully, systematically and consistently applied every year. It is not applied to forests, plantations, expenditure on research and development, goodwill, livestock or land. Accounting Standard 7. It is effective since 1st April 2003. It deals with the accounting for construction contracts. The standard follows two methods of accounting, which are percentage of completion method and completed contract method. Construction contracts are of two types, which are fixed price contract and cost plus contract. An enterprise should disclose amount of contract revenue recognized, aggregate amount of cost incurred, profit realized, advance received, retention, gross amount due to and from customers. Accounting Standard 8. This standard has been deleted from 1st April 2003. This is now included in Accounting Standard 26 as research and development expense. Accounting Standard 9. It is effective since 1st April 1993. It deals with the basis for the recognition of revenue, that is income. It constitutes time when income can be realized and the quantum of income to be credited to profit and loss account. It does not deal with revenue arising from construction contracts, hire purchase, lease agreements, government grants or insurance contracts. Accounting Standard 10. This standard is effective since 1st April 1993. It deals with the accounting and disclosures for fixed assets. It does not relate to forests, plantations and similar regenerative natural resources, wasting assets, expenditure on real estate development, livestock and assets under lease.